Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming out at us right now is overwhelming. Between the AI breakthroughs, the stock market swings, crypto, and the general economy, I just found myself reading endless newsletters and listening to podcasts. But honestly, I can't remember half of it. So I was essentially consuming information piecemeal, missing the bigger picture and how it all connects together. And this podcast is how I fix that. So every Saturday or so, I sit down to synthesize the chaos of the week into one clear narrative. My goal here is really simple. It's to practice articulating complex ideas, to ground myself in what's actually happening and help you connect the dots without having to read the entire internet. It's certainly not about the views and it's not about the hype. So it's just about understanding. Let's get into it. Picture this. You have 18 of the most powerful CEOs on earth. We're talking Elon Musk, Tim Cook, Larry Fink, Jensen Huang, and they're all sitting in a highly secured closed-door room in Beijing. Sitting right across the table from them are Donald Trump and Xi Jinping. The agenda for this meeting is basically a managed, totally controlled demolition of the United States dollar as the unipolar global reserve currency. I know that sounds insane, but they are orchestrating this to prevent a completely catastrophic meltdown of the Western bond market. We've got a stack of sources today outlining a geopolitical and macroeconomic chess game that is so complex and moving so fast the financial mainstream is just completely missing it. We are no longer dealing with isolated sector trends. The data points to a highly engineered, synchronized restructuring of the entire global economy. We are tracking a fundamental rewiring of individual human capability through decentralized AI alongside a massive, forced overhaul of global sovereign debt. To really grasp why those 18 CEOs are sitting in Beijing, you have to look at the pressure building up in the pipes and connect the dots. Our mission today is to connect those dots between these bizarrely autonomous personal AI agents running on local devices and the terrifying math behind a synchronized collapse in global markets, not to mention the physical closure of the world's most critical energy artery. Before we plunge into all those mechanics, I do need to place a very firm disclaimer, and it's basically this. I'm just stating the facts. I'm not trying to, sort of be biased in any way, and it's sort of strictly impartial, right? I don't endorse any of the figures or politics or views, but my focus is exclusively on causality. I'm just reading the tape, right? Okay, so if A happens in the global economy, a global energy market, then B happens in a sovereign bond market, and C happens in tech. The sovereign debt market do not care about domestic political theater, and neither does analysis today. We're just looking at the math and the physics of the global economy, and yet the physics of the economy is actually the perfect place to start, because this whole macroeconomic narrative is entirely driven by the technological reality on the ground right now. The tech is the catalyst. I want to look at the texture of these AI breakthroughs documented in the sources, because we are miles past chatbots writing college essays. The sources highlight some very specific, bizarre anecdotes that prove AI has broken out of the web browser and is interacting with physical reality. I mean, take the story of the CAD file and the water bottle ring. There's a university educator named Billy who possesses zero engineering background, zero CAD experience, and zero manufacturing knowledge. His wife needed a custom threaded ring container to attach to a specific brand of gym water bottle. Historically, if a mass market manufacturer hasn't built that exact bespoke piece of plastic, you just go without. But Billy deployed an AI model called Claude Code essentially as his own autonomous engineering apprentice. He drew a crude, two-dimensional napkin sketch. took a photo of it and told the AI to generate the 3D printable CAD file. The AI didn't just give him a generic rim, it mathematically calculated the threading required to actually grip that specific water bottle. It accounted for the material tolerances of a standard consumer 3D printer and output the physical dimensions perfectly. What's vital to understand here is that the AI is translating semantic intent into spatial and mathematical reality. For decades, the bottleneck in manufacturing was the translation of human imagination into mathematical language that the machine could execute. This anecdote demonstrates the total collapse of the execution gap. The user provided the what and the AI abstracted away the how. The sources note it took 8 iterations, and when early prototypes failed, Billy just took a photo of the failed print, fed it back to the AI and typed that it was too tight on the bottom thread. It was literally a feedback loop via computer vision. The AI analyzed the physical failure, adjusted the mathematical parameters, and recompiled it until they had a flawless product manufactured at their kitchen table. The implications of that zero-skill iterative manufacturing are staggering for global supply chains. We are moving from a paradigm of mass manufacturing and global shipping to highly localized, hyper-customized production. This directly threatens digital commerce and middleman retail. There's an incredible story about a user deploying AI as a consumer defense mechanism against endless Facebook-sponsored ads. It's the whole architecture of digital arbitrage, where cheap products are white-labeled and sold at a massive markup using algorithmic targeting. Instead of reading the ads, this user fed the URL directly to their local AI agent and asked, "Is this a scam?" The AI effectively executed a multi-layered forensic audit. It scraped the landing page, extracted the manufacturer specs, and cross-referenced product images using reverse vision search across global databases. It checked the metadata of testimonials for bot-generated text, completely bypassed the ad network, and found the true factory floor for the item. It actively navigated the user to a totally different industrial supply website where they bought the exact same item for a fraction of the cost. The AI just neutralized a multi-billion-dollar digital advertising complex in about 3 seconds. If you extrapolate that to 100 million consumers, that entire affiliate marketing model implodes. Retailers profit because consumers don't have the time to find the absolute floor price of an item globally. But when personal AI agents eliminate that, symmetry margins collapse to zero for any business that doesn't actually manufacture the physical good. The processing power required to do all that in real time is scaling exponentially. Which brings us to the Google I/O 2026 keynote and the dark pond disaster. The sources highlight a demo of the new Ask Maps feature handling an acute high-stress logistical crisis. A parent types, "My kid just fell into a duck pond and the wedding starts in 30 minutes. Where can I walk and buy her a new dress?" The density of variables in that one prompt is insane, requiring multimodal reasoning, real-time spatial awareness, and semantic understanding. The AI passes the core problem of wet clothes, understands the social context of formal wear for a wedding, and calculates exact GPS coordinates that it maps the retail topography, filters for stores open right now, and accesses live inventory APIs to ensure the item is in stock at that exact second. Then it calculates pedestrian travel time with crosswalks and foot traffic to ensure that transaction happens in under 30 minutes. It is fundamentally transforming the concept of search into deterministic logical execution. But this is where the entire narrative of these sources pivots, and where I have to look at the physical constraints of hardware reality. The server load to run a multivariable calculation across thousands of live APIs for millions of users at the exact same time is massive. These digital miracles are frictionless for the user, but they are extraordinarily energy intensive. This brings us to the core thesis of the dossier: the historic collision between unstoppable technological acceleration and the collapsing reality of the sovereign debt and physical energy crisis. Analysts call this the bifurcation of reality, or the acceleration of the K-shaped world. The hyperscalers like Google, Microsoft, and Meta are trapped in an existential capital expenditure race. Nvidia alone has executed $90 billion in infrastructure deals just since 2025. Google announced Alpha Earth Foundations, a functional digital twin of the planet's ecosystem running deterministic simulations for global food security. They also rolled out Anti-Gravity UI, which dynamically generates custom visual application in real time based on your immediate cognitive needs. But here is the stark reality. You cannot run any of this system on wind turbines and hope. You need uninterrupted massive baseload power, the physical hardware, the silicon, the copper, and the liquid cooling systems. And that infrastructure requires two things that the current global system is rapidly running out of: cheap physical energy and cheap capital. While the tech giants are building digital utopias, the physical world is literally breaking. The most critical data point in this deep dive is the status of the Strait of Hormuz, the vascular system of the global energy market. Intelligence reports indicate that as of March 4th, 2026, Iran officially declared the Strait of Hormuz closed. They executed a blockade backed by asymmetric naval warfare and short-to-ship missile batteries. The International Energy Agency is categorizing this as the largest, most disruptive oil supply shock in record history. It choked off roughly 20% of the world's daily oil supply and a massive percentage of global liquefied natural gas shipments. But the mechanics of this blockade are really about maritime insurance and shipping logistics. Very large crude oil carriers cannot operate without global reinsurance syndicates providing coverage. When missiles start hitting the water, insurance premiums spike to levels that render transit economically implausible. Even if a captain wanted to run the gauntlet, they financially can't. This total severing of the energy artery cascades instantly into the financial system because energy is the bedrock of the inflation index. We just exited a period of historic pandemic-era money printing, and now we are slamming that inflated monetary base into a historic energy supply shock. The predictable result is a violent resurgence of inflation, which is a terminal diagnosis for the global bond market. The math here gets absolutely brutal. Institutional investors hold the debt of national governments like 30-year US treasuries, but when inflation expectations become unmoored, the long end of the yield curve gets decimated by duration risk. If you manage a pension fund, you simply cannot afford negative real yields. If a bond pays 4% on paper but inflation is running at 7%, you are mathematically destroying your purchasing power by 3% every single year. So, institutional buyers go on strike, refuse to buy new debt, and dump their existing holdings. When the price of bonds collapse, the interest rates the government has to pay to attract new buyers absolutely skyrocket. And that's the collision point. Tech giants require limitless capital to build AI infrastructure, but as bond yields soar, the cost of borrowing capital across the entire economy spikes. You cannot finance a $15 billion quantum data center with the risk-free rate of return is surging. This explains the panic in the sources and sets the stage for that meeting in Beijing. The United States cannot organically tax or grow its way out of this debt burden when interest rates are this high. The system is cornered, so it flies its most powerful leaders to Beijing to negotiate a structural reset. Donald Trump didn't show up with traditional diplomats. He arrived with 18 of the most vital CEOs in the world: Elon Musk, Tim Cook, Jensen Huang, Larry Fink, representing the physical, digital, and financial infrastructure of the Western world. Sitting across them is Xi Jinping, who controls the industrial manufacturing base and the rare earth minerals needed to build all that infrastructure. Analysts believe they are negotiating a Plaza Accord 2.0. The first Plaza Accord in 1985 was a coordinated, aggressive manipulation of foreign exchange markets to intentionally devalue the US dollar. It worked for the US, but the fallout for Japan was apocalyptic, sparking a massive bubble that led to 30 years of deflation and stagnant growth. Xi Jinping knows exactly what is being asked of him, and he knows agreeing could trigger a Chinese version of a lost decade. He signaled his understanding of these existential stakes immediately, explicitly warning of the Thucydides trap. This trap postulates that when a rapidly rising power threatens to displace a ruling hegemon, the structural stress almost inevitably leads to kinetic war. Over the last 500 years, in 16 instances where rising power confronted a ruling power, 12 ended in massive bloody conflict. Xi Jinping plainly states that if we are to engineer a new paradigm and avoid a kinetic disaster, the terms must be radically different than what was forced on Japan in 1985. Right after concluding sessions with the US delegation, Xi flew directly into a high-level summit with Vladimir Putin. China and Russia are actively coordinating a Eurasian bloc strategy, using Iran and the blockade of the Strait of Hormuz as a proxy weapon. They are forcing the US to negotiate this Plaza Accord 2.0 with a gun to the head of the global economy. Financial analysts emphasize that the timeline is accelerating rapidly because the plumbing of the financial system is already fracturing. Macro investor Lawrence Lapid explicitly predicted that the bond market math would inevitably break. He outlined the hidden third mandate of the Federal Reserve: financial stability. If the Treasury market starts to seize up due to a lack of buyers, the Fed is forced to act regardless of inflation. We are seeing that seizure happens in real time, with the US 30-year Treasury yield violently breaching 5.12%. It is a synchronized global breakdown, with the UK gilt surging to 5.85% amidst domestic political rebellion. But the most profound structural warning comes from Tokyo, where the Japanese 30-year yield hit 4% for the first time in history. Japan spent the last 30 years acting as the anchor of cheap capital for the entire globe using yield curve control. If their bond is suddenly yielding 4%, it means the Bank of Japan has lost control of the curve and the era of free global liquidity is officially over. Japanese capital will aggressively repatriate back to Tokyo, draining liquidity from US and European markets. We saw this immediately when the US stock market suffered a nearly $1 trillion wipeout in a single trading session. Hovering over all of this is the terminal math of the US national debt, sitting at roughly $39 trillion. Projections show debt reaching levels where the interest expense alone consumes the majority of tax revenues, but there is a glaring anomaly in the sources that defies basic supply and demand. If the strait is physically closed and a fifth of the world's oil is trapped, why is the price of crude oil still sitting under $100 a barrel? Analysts suggest that the price of oil is being artificially engineered to suppress panic while the Beijing negotiations finalize. Western governments are aggressively liquidating their strategic petroleum reserves to create the illusion of ample supply. Simultaneously, the Department of Justice is investigating over $2.6 billion worth of anomalous insider trading in the paper markets. Institutional players with advanced knowledge are ruthlessly shorting the paper market, driving the quoted price of oil down despite the physical reality. They are suppressing the inflation data just long enough to lock in the Plaza Accord 2.0 restructuring. For you as a listener, the question becomes, how do you survive a managed demolition? The consensus is that traditional portfolio theory is dead, and you need a strict barbell strategy. You abandon the middle and weight your capital in the ultra-hard, non-inflatable assets on one side and hyper-growth monopoly infrastructure on the other. Foreign sovereign governments are aggressively dumping the US Treasury's holdings to secure dollar liquidity for oil and to protect the local fiat currency. This massive supply glut crashes prices and spikes yields even higher, accelerating the debt spiral. The endgame is that the Federal Reserve will be forced to implement yield curve control. They will publicly announce a hard cap on interest rates and act as the buyer of last resort, using money printed out of thin air. As usual. But the energy of that suppression goes directly into the currency, radically expanding the monetary base. It is explicit, intentional debasement of the US dollar, stealth taxing every citizen who holds cash or earns a fixed wage. This is the exact catalyst for the barbell strategy. You must own assets that cannot be printed. Wealth is frantically fleeing to scarcity, and with gold surging as the oldest insurance policy against central bank debasement. But these reports also integrate Bitcoin into the defensive tier as a non-sovereign digital hard assets. The Clarity Act is advancing to provide regulatory certainty for massive institutional allocators to hold Bitcoin natively on their balance sheets. Despite high-stakes legislative standoffs over ethics language, the traditional financial system is desperately trying to onboard scarce digital assets before fiat dilution accelerates. On the offensive side of the barbell, we have the infrastructure plays for the new economy. If you are building a digital Manhattan, you don't buy the software startups designing the apps, you buy the concrete, the steel, and the power grid. Google is aggressively teaming up with Blackstone to secure physical real estate and massive dedicated energy infrastructure for data warehouses. The impending initial public offering of SpaceX will alter the allocation of global capital, pricing them as the foundational monopoly of the future space-based economy. The US government is also acting as an aggressive venture capitalist, taking direct equity stakes in domestic quantum computing firms. Whoever achieves quantum supremacy first holds the master key to the global digital economy, as it instantly shatters encryption. The government is taking direct equity because they cannot afford to let the private sector fumble the ball, and they cannot allow Chinese state-backed labs to win that race, which leaves us with a vast, dangerous middle, the kill zone of legacy corporate models and cognitive human capital. Starbucks completely scrapped its AI inventory tools, highlighting that generic corporate AI is failing. But the more chilling disruption is in the labor market, where the big four accounting firms are posting more jobs for AI specialists than human auditors. An AI model can ingest an entire unstructured database and output the probabilistic risk assessment in 30 seconds. Data entry, middle-level analytics, and compliance monitoring career paths are being structurally eviscerated. The analysts also point to technical health warnings in the equity market. The S&P 500 is showing negative divergence, where price is hitting all-time highs but underlying momentum is steadily declining. The entire index is artificially propped up by a tiny handful of mega-cap tech stocks capturing 89% of all generative AI startup revenues. If those monopolies stumble, there is no underlying foundation to catch the fall because the consumer is breaking. Auto loan delinquencies have reached a 32-year high as inflation utterly destroys real wage purchasing power. And in historical volatility from a midterm election year, and you have a profoundly fragile equilibrium. The K-shaped economy divergence is mechanical reality. The top half ascends via asset inflation and AI leverage, while the bottom half is crushed. Historically, when extreme divergence leaves a massive percentage of the population with zero prospect of upward mobility, severe social unrest is a mathematical certainty. Intelligence sources suggest central planners are fully aware systematic unrest is imminent. Their solution is not to fix the inequality, but to implement a comprehensive digital control grid. It is the fusion of mandatory digital identity with programmable central banks' digital currencies. Money ceases to be a bearer instrument of freedom and becomes conditional software, coded with restrictions directly in the currency itself. They can mathematically restrict your wallet from purchasing gasoline or geofence funds during periods of civil unrest. The technology that empowers automated manufacturing at a kitchen table is the exact same underlying architecture that can be inverted to build a programmable prison. So, the final question you have to ask yourself isn't just about how you allocate your portfolio. If your assets are mathematically safe from inflation, is your physical autonomy safe from the grid? Thank you for joining me on this deep dive. I highly encourage you to question the true cost of the frictionless technology in your pocket and figure out exactly which side of the K-curve you are standing on. I think it's really interesting because I was having a conversation with a taxi/Uber driver, and the thing they pointed out is how people never have cash on them, and all these larger monopolies like Uber and FreeNow and the like tend to take 25% commission, and it's simply something that is out of their control. And trying to start your own company is essentially pointless because none of the users or market base know about your company, and thus everyone continues to default to the Uber, Bolts, and FreeNows of the world. And it's actually scary because, as the question I just posed is, how much and what is the true cost of this frictionless technology, technologically, refined world we live in? What's the true cost of that, and what does it mean for our freedom? Anyway, on that dark note, I leave you with that. Have a mull over it, and I will catch you next week.